What's up, Main Street? How y'all doing? I got a question for you before we start. This is a question from my friend Sam over here. Sam, water wet? Is what water touches wet or both?
Mm, I'm not entirely sure. I'm inclined to say that water is wet, but I'm not a scientist, so I've never really thought about it too much.
Perfect. And that's exactly where we are with the SCOTUS rulings, the economy, and everything that's coming out. So part of what we're going to do in this Main Street meets Wall Street episode right here, we have an insider, business insider journalist, Samuel Brent. He's going to hop in with us for a little while. We're going to talk about SCOTUS. We're going to talk about uh, geopolitical tensions. Some stuff might happen this weekend. We're going live in case you don't know. Talk about the dead money rotation, trade policy, and the kitchen table inflation, and then we'll also talk about Main Street's impact on AI and its disruption. So, without further ado, I'm going to go ahead and let Sam just jump in and start talking. Sam, obviously everyone has heard today about the Supreme Court ruling. Uh, what are you hearing on the inside, Samuel?
Hi, Marcus. Thank you so much for having me. Now, I would say that, well, firstly, this ruling just happened, so I have personally not heard too much. But what I would say is that based on the very smart people, almost all of whom work in finance, who I have spoken to and heard from in the past few hours, the consensus is definitely that this development is positive for the stock market because, as many have said, the uncertainty that has sort of clouded markets for months based on just the sheer not knowing what Trump is going to do, what he can do, and what's going to happen has cast a bit of a dark shadow. But temporarily at least, that's been lifted. And most people were not surprised that market moves were a bit tepid today because, according to what I heard, it was sort of assumed that this was going to happen. Now, of course, no one really knows how Trump is going to move forward. He gave a statement and he was not happy about the ruling. So we're still in the wait and see phase, but for now, the consensus is positive for Wall Street.
Nice. Yeah, it was interesting when they first announced it. I heard them say something when he was speaking about 10% cap, and it seems like Wall Street was just kind of like, okay, we can deal with 10%. Wall Street, one thing that people don't realize, like Wall Street and these giant investment banks or corporations, they're pretty agile and they know how to figure out different moves and different things. They just kind of want the rules, and like Samuel said, they kind of want to just have a clear roadmap to whatever that may be. On the other side of that, you say I'm hearing people respond that this actually just created less clarity. As I listened to President Trump's conference today, and he was speaking on things that they can do now, and it may take tariff levels higher, but for shorter periods of time. Are you familiar with anything like the Section 122 or parts where we can only tariff countries where we have a deficit? Just different. I know this is all hot off the presses.
I have not heard too much about that just yet. Still looking into it. When my team put out a feature on the impact today, it was mostly with context from people who were reacting to the news and assessing the immediate impact on the market. As far as what may happen in the future, I think it's a little tougher to say. We know that Trump is someone who reacts quickly, and if he doesn't like something, he's not shy about letting us know. But right now, I just think because he is so unpredictable, it's difficult to say. And I think it will be moving forward.
Yeah, and that goes right into the next topic, man. The unpredictability. We're in excessive geopolitical tensions around the globe. We know that we have our largest carrier going to reinforce another aircraft carrier in the Mediterranean. What are you hearing from insiders regarding this move? Are people looking to invest in oil, or what? Are they just taking this as because Trump's unpredictable? I mean, if you just think back to the original Iran strike, we sent our planes around the other way. He said 10 to 15 days before something happens, but he's not going to just show his cards on this move if he makes a move.
No, absolutely. Now, regarding oil, So most recently, I saw an interview with Goldman Sachs's head of oil, who spoke to CNBC about this exact topic, and I believe he said that that their base case isn't too impacted by the uncertainty surrounding the U.S. and Iran's tension right now. Both nations have made it clear that they don't want to back down, and of course, Iran knows that its leverage with the U.S. lies in oil, typically the Strait. And as Goldman's head of oil mentioned, if they were to reduce oil flows into the U.S. to EFS just for the coming year, that would severely diminish the U.S.'s supply. And of course, supply and demand math make it pretty clear that this would definitely push prices up. According to what I've seen, prediction markets are pricing for moderate escalation as the base case and the long-term supply disruption as a meaningful but fairly small tail risk. Last I saw, they were signing odds that were roughly 60 to 75% that the US and Iran would see some form of kinetic escalation, which could mean strikes, could mean actions on the oil front. However, they maintain that odds of a full-scale conflict are significantly lower. I think they were in the single digits to low teens last time I saw.
Gotcha. That's very interesting. So odds that you can jump into a hot war, but not necessarily. It sounds like they're expecting for this to be a shortened engagement, perhaps.
That does seem like the consensus as of now, based on prediction markets. But of course, things can change quickly. I know that Trump gave some statements on, I don't know if he gave statements, but I know there were headlines regarding Trump and Iran today. Was focused on other stories, so I was not able to look too closely. But it does seem like that is the consensus right now, that traders are not anticipating a significant spike in oil prices, but with the lack of clarity around what's going to happen, they can't rule out some risk that would push prices higher.
Got you. I've never played the poly market, so I don't quite understand. I understand they work. I've never done it, but I know that the odds are like they're higher or lower depending on how far out you're investing or into the when it's going to happen. The hit, the action, the kinetic motion inside of Iran. And do you know like what the odds are if it happens like this weekend?
Not specifically. I had not looked too recently, but the odds I mentioned were from, I believe from, I think yesterday. So they're pretty current. But as I noted, they can change pretty much on the dot,
Yes, they
depending
can.
on how people are feeling. Sometimes it's reactionary.
Right. Do you think poly markets, and I'm sorry we're veering off a little bit, do you think poly markets have become like predictive markets? Like it seems like you can pick the winner with those.
That definitely seems to be the definitive consensus. You may have seen that the Federal Reserve just put out a report on Kalshi, Prime Market's biggest rival, essentially touting its prowess as as a means of gauging economic outcomes. The power of these platforms has certainly become undeniable. I remember when they were just for sports gambling, people would laugh about how you could bet on the weather, but now they're everywhere, and there's no denying that investors are using them for other things. A while back, I spoke to Danny Moses, the trader from The Big Short, if anyone has seen that film,
Great
and
movie.
he was happy to tout just how important prediction markets are as a tool in the investing world.
Got you. What's his forecast for the world right now? Is he a pessimist, a bear, I guess? Michael Blurry clearly is.
The last time I spoke to him, he was still bullish on the AI market. As far as the world goes, we didn't discuss that. When it comes to conversations with people in the financial sector, I try to stick to financial questions.
And now we're going to shift into this dead money rotation, man. That was a great explanation for Main Street, right? There's been a growing narrative among tech strategists about the Mag 7 and how it's become dead money and
Yeah.
how we're kind of seeing the new economy money flowing into other areas. Based on the flow of your funds that you've been tracking, is that fundamental shift in investor appetite? Is that what you're seeing?
Definitely seems to be the consensus. Now, can I quickly explain the concept of dead money for anyone who might not know that term? So, most recently, I was listening to George Noble's podcast in which he discussed that concept with Brian Shannon from Alpha Trends. Brian is a technical strategist, and he laid out that concept, I thought, very well, in which he described it as essentially a stock that is, let's just say, unlikely to generate meaningful returns for investors over the coming period. Now, it doesn't necessarily mean a crash. That's not what he was saying, but that its price action is essentially stagnant. A stock that trades, let's say, in a range for months. He used examples like Nvidia and Microsoft. I don't think anyone would say that those are bad companies to own. They've been incredibly strong performers over the AI boom, Microsoft for even longer. But right now, as he noted, they've both been kind of stagnant price-wise. And the other part of the dead money concept involves how capital rotation is taking place, in which investors are rotating money out of these companies into other ones. On that episode, the consensus was definitely that things are shifting into areas like, say, utilities and energy, areas that might not make quite as many headlines or seem as exciting as these big tech stocks, but that experts see as having overall more growth potential.
Got you. And clearly a cyclical rotation is happening, right? As you see international picks up, we've seen a shift in the value, like these energy stocks, right? The new tech stocks, like, is that what people are trading on now? Another one, speaking of dead money, a good example, and I got to put my hand up on this one, is Oracle. We spoke about Oracle earlier this year. I still have the same thesis on Oracle. Not making stock recommendations for anyone on the show. Oracle, I said, would be dead money. We were speaking for probably the first half of the year, but I expected to bounce back. But it's exactly what Samuel just described.
Exactly. I can confirm that Marcus did, in fact, make that prediction multiple times when we spoke.
Yeah, I probably shouldn't be saying that on air right now because it doesn't look like the greatest one. But it's what it is. It's what it is. Let's talk about trade policy and the kitchen table inflation. We had GDP come out today that was 1.4, expected to be 2.8. And I'm hearing people talk about GDP. They're trying to square the 1.4 versus 2.8 and maybe tie in seasonality. When it comes to those numbers, Main Street, just try to take a trek of 3 or 4 months and smooth those out. But then we also saw the PCE, which is the Fed's preferred gauge. I'll let you speak a little bit about that for measuring inflation, come in a little bit hot, 4 tenths versus 3 tenths. So if you want to jump into that for us, Sam.
Absolutely. So I think you kind of just said it all. It was a little hotter than expected, and numbers being a little better than expected has kind of been the name of the game with economic data lately. When the January jobs report came out after a 5-day delay, things were definitely better than better than expected. And of course, when that happens, the immediate reaction is to say, "Oh, this is good. This seems like the economy is rebounding." And some say it is, some say that it isn't. I have two different economists who I've written about recently who I can compare who have taken different stances. Ed Yardini from Yardini Research predicts that we're not going to see any kind of recession because the economy, in his view, is just too resilient. The U.S. economy, I should say. He had talked about how he just thinks the resiliency is strong enough that we are going to see what he called another roaring 20s. And he didn't mention anything about how the original roaring 20s ended in a stock market crash. So that I'm not sure about. But he did mention that and touted the growth of the S&P 500, boosted mostly by AI stocks as a reason for his bullishness. Now, on the other hand, there's Mark Zandi of Moody's, who is someone who I've interviewed multiple times and who has been very good at showing the data when he has a prediction. And when the jobs report came out for January, he shared a chart that showed that yes, it's true. In January, the numbers were better than expected, but very late in the year in 2025, the job numbers were pretty bad. They were in the red. So yeah, it's easy to celebrate when report comes in a little above line in the green. Zandy also predicted that we would not be seeing too many months in 2026 with this kind of job growth. Right now, it seems that, as they always are, experts are mixed. But those with all the data seem to be erring on the more bearish side when it comes to overall economic rebound.
Got you. Yeah, Dr. Ardanis, he is one of the most bullish people you're ever going to meet. And yeah, a good point that people seem to forget about is that the roaring 20s of old ended in the Great Depression. But a lot of things are so different now versus when that happened. I mean, you have the speed of information is what I see is like the greatest difference in between then and now. They were sitting there waiting for hours to find out what happened with those trades, and people were trying to panic sell. It's just, yeah, it's just so hard to be in the dark with this stuff right now. But it does move so fast.
No, absolutely. There's a great book by Andrew Ross Sorkin that recently came out on the crash of 1929 that does a great job of highlighting exactly what you mentioned. One of my teammates at Business Insider, a Will Edwards, had a great piece on it and illustrated that extremely well. That these days, when people talk about the stock market crash, because we're in the 20s again, it can be tempting to lean into the mindset of, oh, it's going to happen again. But as you just said, it's definitely true that certain things are very different this time around. So it's really impossible to say.
People can have the information, but if you look back to historical crashes in the U.S., like 1907, that was, actually private individuals came in and saved the economy that time. They created the Federal Reserve, right? Because that will help us if we get into a situation like that. But 1929, when the market did crash, the Federal Reserve made the wrong move and tightened money. So they made money harder to get, raised rates when they should have loosened money. Hopefully these Fed people are learning from all of history. And then we have Kevin Warsh coming in. I mean, I know we got another topic to cover, but what are you hearing about Kevin Warsh while we're digging into this Fed stuff, man? How is that affecting the markets? Because everything went down the day that he was announced.
Well, there are certainly concerns about Fed independence. Now, based on what I've seen, the general consensus among economic experts is that Warsh is a fair choice. Those are Mark Zandy's words to lead the Fed. And it doesn't seem that there's too much negative speculation about Warsh being chosen. I think partially because it wasn't that surprising when he was chosen. As I understand it, for a long time, Trump was between two guys named Kevin. And they weren't that different as far as Fed choice candidates goes. And of course, with all the tension between Trump and Powell that had happened over the past, I'd say past few months, but really it's more like most of the past year because just so many questions and so much just not really knowing what's going to happen with the Fed, which of course is supposed to be an institution that we can rely on to always know what's going to happen because that's why they're there to help provide these economic answers. And based on heard though, it does seem like the market's response to Warsh's appointment might have been a bit of a knee-jerk reaction, and that I remember some experts saying that when the dust settled, conditions would stabilize fairly quickly.
The last part you said again?
Based on my understanding, some economic experts had definitely said that once the initial shock of Warsh's appointment sort of wore off, market conditions would stabilize because ultimately he was seen as bullish for the stock. His appointment was seen as bullish for the stock market.
Whenever a new Fed chair comes in, the market always finds something. Something's always happening. I don't know if it's causation or correlation where that Fed chair is challenged. I don't think anyone, even on the finance committee, has a problem with Warsh. I think he was nominated and unanimously last time. I think Chuck Schumer brought him to his nomination. So I don't think anyone has a problem with him. I think, and down here in North Carolina, Wall Street South, Tom Tillis is my senator. He has a problem with the process going on. We're not going to dig into all that right now. But I want to dig into one last point on how Wall Street, everyone's so worried about AI. I was talking to Adam Parker earlier. That episode will come out later. And we just talked about, he gave me examples of how AI can disrupt his industry, specifically what he does. He does research at Trivariant for the institutional investors.
AI is disrupting essentially every industry. And it seems like that question's too big to, sure. I mean, not too long after, Marcus, you and I actually discussed discussed the impact on stocks in the on brokerage companies like Schwab and Fidelity, because of course an altruist rolled out that update, and of course this came just after the software sell-off, and of course I remember stocks falling, but it wasn't anywhere near to the point that it was what was happened with software. Brokerage stocks bounced back fairly quickly, even after it became common knowledge that altruist had the little update that was, I should say, the plugin that kind of enhanced its capabilities for financial advisors. Ultimately, as far as AI disruption goes, it's difficult to really say overall, other than the fact that it seems poised to disrupt most industries. But I do have to give you credit for being correct when you told me that you didn't see the altruist news as having a long-term impact on brokerage stocks.
Well, thank you. And yeah, Sam and I, for those who don't know, me and Sam have done a lot of stuff together. Sam's a really great journalist or writer. I don't know. I need Sam to elaborate on that at some point, the difference. But we've done a lot of good collaborations, I don't think, throughout like this whole entire year, last year. But yeah, one of the things I saw is like Altruist, and full disclosure, I use Altruist as my custodian. Altruist uses Hazel, which is the AI tool, to enhance advisors so we can help our clients in that type of way. Boom. You heard it there. AI can't do that. I love it, Sam. That's good stuff. Like I said, I want to respect your time. Sam was only going to talk to me for like 10 minutes, I think, and I just kind of stole him, and he's such a wealth of information, man. I appreciate it, Sam. If people want to get in touch with you, or if they need anything from you, how could they reach out to you?
Well, the best way to reach me is on LinkedIn. But if you have a tip or a story that you think I should hear about, I am reachable at SOBRIENT, last name, at insider.com.
Got you. And the LinkedIn was fine, the Business Insider, where if someone wanted to send something in, what did you say?
Yes. So I am reachable at SOBRIENT, first initial, last name, at insider.com. And I'm also on Signal. If you'd like to chat with me on there, message me. We can go from there. The only place you can find my work these days is on BI. Marcus, thank you for having me. It has been really great to chat, as always. Thank you all.